Picture your inbox or, your social media feed right now.
Oh, it's a disaster.
Right. It is probably just flooded with get-rich-quick financial influencers.
Yeah.
Ones standing in front of rented Lamborghinis, pointing at random charts.
Usually shouting.
Always shouting, promising you'll make like 7 figures by next Tuesday if you just buy their masterclass.
Yeah, the noise is just deafening. It's this entire ecosystem built on hype, volume, and instant gratification.
And honestly, it is exhausting. So today, we are cutting through all of that noise. We're looking at the exact opposite.
Which is much needed.
It really is. We're doing a deep dive into the quiet, mathematically dense intersection of advanced life insurance and real estate.
It sounds dry, but it is actually fascinating.
Totally. We're examining source materials from Scott McDonald, the founder of Fortis Financial Group. And our mission for this deep dive is to map out a radically different approach to wealth building.
One that requires, deep structural understanding. It completely shifts how you view financial risk.
Exactly. So to really grasp this shift in perspective, we kind of have to start with the industry landscape, right?
Yeah, we do. And McDonald lays out a really blunt critique of typical life insurance agencies.
The standard model.
Right. Most of them, they don't actually train their agents to think critically about finance. They train them to read scripts.
Just hand them a binder and say, go sell.
Pretty much. They push them to sell these instant issue burial policies to, anyone with a pulse, starting with our own friends and family.
Oh man, the sell to your friends model.
Yeah.
It's so awkward. So it's really just a sheer volume game.
Exactly.
It's about keeping the agent incredibly busy making money for the agency rather than actually building a sustainable, thoughtful career.
What's fascinating here is Fortis's alternative philosophy. They actively reject that volume model.
Okay, so what do they do instead?
They operate exclusively in what they call advanced markets.
Advanced markets.
Yeah. This isn't about selling a basic term policy just so someone's funeral is covered. This involves strategic leverage and highly complex cash value accumulation strategies.
Using life insurance.
Specifically, using dividend-paying whole life insurance. McDonald argues that confidence comes from clarity.
I like that.
Right. These tools shouldn't be off limits to everyday investors, but they require deep structural understanding by both the agent and the client.
So if standard insurance sales is like, pushing identical products out a fast food drive-through window, this sounds more like culinary school or like civil engineering for your personal economy.
Great way to put it.
It is like building a massive dam to control the flow of your capital rather than just letting it wash away downstream.
Exactly.
But, why use life insurance as the concrete for that dam? How does this advanced market theory actually function out in the real world?
Well, McDonald introduces the core mechanism with a question that immediately forces a double take. He asks, how many of us would buy a rental property without insurance?
Obviously, nobody. You insure the physical building against a fire or, a flood.
Right. But then he reframes it entirely. He asks, why do so many investors buy real estate without a financial foundation that functions like insurance for their capital?
Okay, let's unpack this. Because this is where my brain initially hit a wall when I was reading the material.
It's a huge paradigm shift.
It really is.
Yes.
He is talking about using a dividend-paying whole life insurance policy as a private bank account, as a capital reserve.
Yes.
But usually, life insurance is just a monthly expense, right? You pay a premium and, when you die, your family gets a check.
That's the standard view.
So how does a death benefit policy become a private capital reserve for buying real estate?
It requires unlearning pretty much everything we are generally taught about where money should live.
Okay, unlearn it for me.
We are taught how to acquire assets, right? But not how to protect the capital used to buy those assets. Traditional banks and Wall Street, they make their money when your capital is exposed to the market.
Yeah.
This strategy, which is often called the infinite banking concept, or IBC, is not an investment in the traditional sense. You have to think of it as a capital warehouse.
A warehouse.
Yeah. It serves as a buffer against unbuffered volatility.
Unbuffered volatility. That's a great phrase. Define that for me in practical terms. What does that look like for you or me?
Think back to the 2008 financial crisis, or even the early days of the COVID pandemic.
Oh, yeah. Chaos.
Utter chaos. Investors who are relying on home equity lines of credit Hilo X to fund their real estate deals suddenly found their credit frozen.
I remember that. The banks just locked the doors.
Exactly.
The equity was technically still in the house, but the access was completely gone overnight.
Because traditional banks changed the rules mid-game. When the broader market gets volatile, they pull back.
To protect themselves.
Right. And because of that, people lost access to their own equity and were forced to sell properties at a massive loss just to cover their liabilities.
Wow.
But the loans within a properly structured infinite banking policy are contractual.
Contractual meaning?
Meaning they cannot be frozen by the insurance company just because macroeconomic conditions are bad.
Wait, really? Even in a crash?
Even in a crash. They don't require credit qualifications, and they don't even appear on your credit report. It gives the investor guaranteed liquidity in all environments.
So you aren't forced into desperate moves.
Exactly. If we connect this to the bigger picture, real estate rarely fails because a house is inherently bad.
Right. The physical asset is usually fine.
It fails because volatility like sudden rate spikes, unexpected vacancies, or those credit freezes hits at the exact wrong time.
Timing is everything.
IBC removes this forced timing. You borrow from your own policy on your own terms.
Okay, but having a warehouse is useless if the doors are jammed, though. If I put my money in a standard checking account, I'm earning practically 0% interest.
Unfortunately true.
So how does the money move in and out of this insurance policy without stalling my momentum? Does it just sit there doing nothing?
Not at all. Inside an IBC policy, your capital is doing something very different, and it's anchored by a historical track record of stability.
How stable are we talking?
Well, the specific mutual life insurance company they utilize for this strategy hasn't missed a dividend payment in 135 years.
Okay, let's stop and look at that timeline, because that is a massive claim.
It's incredible.
135 years, that covers the Great Depression, 2 world wars, the dot-com bubble, the housing crash in 2008, and, the recent pandemic.
All of it.
Through all that catastrophic global volatility, the dividends remained intact. Why? I mean, how is an insurance company immune to a stock market crash that literally wipes out traditional banks?
It comes down to how mutual insurance companies invest their general fund. They aren't day trading tech stocks or, gambling on high-risk derivatives.
No Lambo bros at the insurance company.
Definitely not. They invest heavily in highly rated long-term macroeconomic bonds, commercial mortgages, and massive infrastructure projects.
Very boring. Very stable stuff.
Extremely boring. Furthermore, they are legally required to maintain enormous cash reserves to pay out death claims.
Oh, because people are always going to die,
right,
regardless of the economy.
Exactly. That forces them to be incredibly conservative. That structural insulation from the stock market is what allows them to pay uninterrupted dividends for over a century.
Okay, that explains the stability. But McDonald is very upfront in the material that this isn't some magical overnight solution.
No, not at all.
In fact, he uses a semi-truck analogy to explain that the early years are actually quite difficult.
Yes. The early years of funding an IBC policy require a lot of discipline. In years 1 through 3, your cash-on-cash return is technically negative.
Wait, negative?
Yeah.
So if I put like $110,000 in during year 1, I do not have $110,000 available to use.
Correct. You might only have about $103,000 available in liquid cash value.
That feels like a bad deal up front.
That upfront capitalization cost deters a lot of people who don't understand the long-term mechanics.
What am I paying for that?
You are paying for the actuarial cost of a massive, legally binding death benefit, say $1.5 million right out of the gate, alongside the administrative fees to actually set up the contract.
Which brings us back to his analogy. You don't take an 18-wheeler semi-truck to run quick errands at the grocery store.
Right. It's clunky.
It takes a long time to get up to speed, and it's expensive to fuel up initially. But you use a semi-truck to haul heavy freight cross-country.
Yes.
A standard checking account is your daily driver for buying milk. IBC is your heavy-duty cross-country wealth vehicle. You just have to spend the time and money to get it up to speed.
And once that massive vehicle is up to speed, we encountered the single most critical technical detail of this entire strategy.
Lay it on me.
It is a concept called non-direct loan recognition.
Okay, big words. Explain how this works when I actually want to buy a property.
Let's say you've built up your cash value and you need $90,000 for a down payment on a duplex.
Okay, got my eye on a nice duplex.
In a traditional savings account, you withdraw that $90,000, it's gone. It is no longer earning any interest for you at the bank.
Because it's in the house now.
Right. But with IBC, you don't withdraw your money. You borrow against the policy.
So I'm leaving my capital inside the warehouse.
Exactly. You borrow capital directly from the insurance company's general fund, and you use the death benefit and the cash value of your policy as the collateral.
Okay.
Because of non-direct loan recognition, your original capital continues to earn uninterrupted compound interest and dividends inside your policy.
Wait,
Just as if you had never touched it.
hold on. I need to push back on this.
Go for it.
I'm borrowing money from the insurance company to invest in a real estate deal.
Yeah.
Let's say I'm borrowing at a fixed 7% interest rate.
Fair assumption.
What happens if the real estate deal goes completely bust?
Yeah.
The market tanks, the property sits vacant, I can't rent it out.
The worst case scenario.
Right? Now I've lost the real estate. I owe the insurance company 7% interest on a loan. Doesn't this strategic leverage just amplify my risk of ruin?
That is the exact risk you take with any leverage, and it is a crucial point to understand. However, the structure of the policy loan offers a unique safety net that traditional banks do not.
What kind of safety net?
Because the loan is heavily collateralized by your death benefit, there is no mandatory monthly repayment schedule.
Wait, really? No monthly payment?
No.
Yeah.
The insurance company isn't going to foreclose on your primary home or send you to collections.
They just let the interest accrue against the policy.
Precisely. The loan interest simply accrues and reduces your available cash value and ultimately your death benefit.
So it eats into the policy itself.
Right. If you die with an outstanding loan, the insurance company simply subtracts the loan amount from the total death benefit before paying your heirs.
Oh.
It gives you incredible breathing room to recover from a bad deal without facing immediate bankruptcy or a forced liquidation.
Making your money work in two places at the same time, but with a built-in shock absorber.
Exact.
Okay, let's apply this to the actual math. We really need to look at the specific scenario McDonald models with the New Dawn Freedom Fund.
Yes, the numbers really help clarify this.
They use a 35-year-old male investor as the baseline. To get the semi-truck moving, he puts $110,000 up front into his IBC policy. Then he commits to putting in $10,000 a year for the next decade.
So he is steadily feeding the warehouse, building up that liquid cash value.
Here's where it gets really interesting. You cannot just dump unlimited cash into these policies forever.
Nope.
The source outlines that around year 11, his maximum allowable contribution drops to just under $9,000.
That drop is dictated by the IRS.
Why does the IRS care?
Well, if you overfund a life insurance policy, like pouring in too much cash compared to the size of the death benefit, the IRS reclassifies it.
Reclassifies it as what?
As a modified endowment contract, or a MEC.
Okay, what happens if it becomes an MEC? Is that bad?
You lose the tax advantages. Normally, the internal growth inside the policy is tax deferred, and the loans you take out are tax-free.
Nice.
But if it becomes an MEC, any money you pull out or borrow triggers income taxes on the gains, plus a potential 10% penalty if you are under 59.5.
Ouch. So you definitely don't want that.
No. The funding limits are mathematically engineered by an actuary to keep the capital legally insulated from those taxes.
Okay, so the policy is funded legally, the cash value is growing. Let's walk through the actual real estate transactions slowly, because the numbers here are intense.
Very intense.
The investor executes a 90-day arbitrage strategy. He takes up to 90% of his available cash value out of the IBC by borrowing against it.
Right.
The cost to borrow that money from the insurance company is an annualized rate of 7%.
That 7% is your known controlled cost of capital. That is your hurdle rate. You have to beat that.
He takes that borrowed capital and hands it to the New Dawn Freedom Fund for a short-term 90-day deployment. Now, the source material models a 5% return in month 1, and then a 1.25% weekly compounding return for days 31 through 90.
Which creates a significant margin.
Wait, stop. Back up. 1.25% weekly. You and I just spent the first minute of this deep dive making fun of Lamborghini influencers pushing unreal returns.
Sure.
1.25% weekly is astronomical. How is this any different from the get-rich-quick hype we are supposedly cutting through?
It's a critical catch, and I'm glad you brought it up. The difference is the asset class and the duration.
Okay, explain.
This isn't a long-term passive stock market return. The New Dawn Freedom Fund is operating in highly specialized short-term transactional real estate.
What does that mean in plain English?
They are funding immediate cash needs for flippers, wholesale deals, or bridge loans, where a real estate developer is willing to pay steep premium interest rates for 30 to 90 days of immediate liquidity.
Because the developer needs the cash yesterday.
Exactly.
So it's hard money lending, high risk, high velocity.
Exactly. It requires active, aggressive management. The math holds up for short-term bursts in specific real estate transactions, but you could never sustain a 1.25% weekly return compounded indefinitely over years.
Okay, that makes more sense.
It's a 90-day tactical strike.
That context is essential. Let's look at a concrete dollar amount for the spread then.
Yep.
Let's say I borrow $100,000 from the policy at that 7% annualized rate.
Okay.
My cost to hold that money for 3 months is roughly $1,750.
Yes. And if the real estate fund delivers its projected return over those same 90 days, you might generate around $10,000 in gross profit. You take that $10,000, subtract the $1,750 you owe the insurance company, and your net arbitrage profit is over $8,000.
Wow.
You pay back the principal to the policy to replenish your available credit, and you keep the difference.
And while all of this high-risk, high-velocity lending is happening on the outside, the original $100,000 inside the policy is still completely safe,
Untouched.
earning those 135-year-strong conservative dividends.
It's dual action compounding.
Let's zoom out to the 30-year horizon just to see the end game. After 30 years, our investor has put a total of $388,000 in premiums into the policy.
Okay.
The policy alone, the insulated warehouse, is now worth nearly $1 million in liquid cash, plus a massive death benefit for his heirs.
And that is just the baseline infrastructure. That happens even if the real estate market completely stalls and he never does a single outside deal.
Just from the dividends.
Just the dividends and guaranteed growth.
But if he is simultaneously taking that borrowed capital and executing just 1 to 3 of these 90-day hard money real estate deals a year for 30 years.
The math gets crazy.
It really does. The arbitrage yields an additional $2 million to $6.2 million in profit. You have the $1 million secure battery plus the multi-million-dollar real estate engine.
It's the perfect illustration of why Fortis insists that advanced markets require deep understanding. You aren't just buying a life insurance product.
Right.
You are architecting a multi-decade financial ecosystem.
So what does this all mean? The core takeaway here is that wealth building isn't just about finding the highest yielding investment.
It's not.
It isn't just about building the biggest, fastest engine. If you drop a massive 800 horsepower engine into a car with a terrible transmission and no brakes, you are going to wrap it around a tree.
Exactly. It's a recipe for disaster.
Wealth is about building an insulated infrastructure, a reliable, high-capacity battery to safely power that engine.
This transition from merely acquiring assets and chasing returns to actively protecting and leveraging capital is the dividing line between amateur hype and professional financial architecture.
Well said. And we should probably remind you that we aren't giving you personalized financial advice today.
Oh, definitely not.
We are just exploring the mechanics of a concept that challenges conventional wisdom about where your capital should sit while it is waiting to be deployed.
Which leaves us with a final thought to consider.
What's that?
Well, we've seen how everyday investors are using century-old mutual insurance companies as private banks to fund real estate, essentially bypassing traditional lenders entirely.
Right.
This raises an important question. If building a personal capital warehouse works as a buffer for the intense volatility of real estate, what other areas of your life, your business, your emergency funds, your family planning, are currently exposed to unbuffered volatility simply because you were taught to acquire assets rather than protect capital?